Depending on who you ask, we're currently either in or nearing a recession. And to top it all off, we're also seeing a period with very, very high inflation. In fact, we are seeing some of the highest inflation numbers that we've ever seen. It's quite likely that we're looking at a multi-year worldwide economic downturn. And it's quite easy to see why people believe this and where the concern is coming from. After all, debt levels are very high, interest rates are increasing, and inflation is not slowing down. It's still making things really expensive for all consumers, and it seems like almost every major asset group in the investment world is seeing a sell-off, which raises some pretty important questions for investors. So, how should we prepare? What do people typically flock to during recessions? And is it worth my attention? Let's sit down and have a look. Hi, and welcome to Finance for Fun. As many people know, the market tends to trend down during a recessive period. But the recession that we are looking at is very different from the ones that we have seen in the past. Why is that? It's important to know that no two recessions are alike. The current one is showing some traditional signs like the economic slowdown, which is textbook technical definition of recession, but there's also some things that aren't as usual. First of all, the labor market is currently still robust. During most recessions, economic output and employment decline at the same time. As revenue slows down, businesses are compelled to cut back on staff, which leads to higher unemployment, and ultimately higher unemployment that leads to lower consumer spending, which creates a vicious cycle. However, during this recession, unemployment is still at a record low. The official unemployment rates are around 3%, I think, which is pretty much a 50-year low that we reached just before the pandemic. A robust job market is historically unusual during a recession, which makes this recession pretty unique. Second, companies are still cash rich. Corporations tend to see a decline in sales during recessions, and while that process may have already started, lots of companies still hold considerable cash balances. After the COVID pandemic, corporations were able to sustain or even increase profits in order to create gigantic cash hoards that they are now still sitting on. Additionally, the era of easy money and low interest rates that we have just come from has allowed companies to easily build up extra cash, as financing for any money needs was incredibly easy. Now, even though we're hitting a recession, this cash is acting as a buffer and it can allow companies to retain staff despite the economic slowdown. Third, interest rates are rising. Another unusual factor is that the Federal Reserve is currently increasing interest rates. In most recessions, the central banks tend to cut interest rates and add more money to the economy in order to stabilize it. However, right now, the Fed is aggressively raising rates to curb inflation, and the ECB is doing the same. Considering the strength of the job market and corporate balance sheets, the central bank may have more reason to keep raising rates. All in all, this scenario looks to be unsustainable. It's likely that either one of two things will end up happening. Either the economy recovers swiftly, ending the recession outright, or the economy slowly keeps dipping, compelling employers to, in the end, cut jobs and able to make ends meet. It might be good for investors to keep an eye on indicators to see which scenario is playing out, because the impacts could be severe. If the recession ends up not being as big a deal and we recover quickly, it might be a good time to take a look at the beaten down growth and tech stocks. However, if the recession ends up being more difficult than we expected, it's probably best to take refuge in asset-backed defensive stocks like healthcare or real estate. Either case, the next year is shaping up to be very interesting for investors. So, what are some of the strategies that we are seeing amongst investors? Let's start with the most radical, but perhaps the simplest strategy that we see. Number one, selling everything. For those who really can't bear the thought of losing any more money, selling everything might seem like a compelling option. Sadly, this is often not the case. It tends to be a losing strategy. The stock market is a little clunky in that most of the returns and the losses are often determined by a few key days. If you liquidate your entire portfolio in order to try and prevent damage, you'll also very likely miss out on the best days of the market. This can really hurt your performance. If we take a look at this graph, we'll see that missing some of the best days ends up really hurting our performance. So, in conclusion, trying to sell off everything and then buy at a later date is like trying to win the lottery. You're trying to predict the future, which really no one can do very well. Okay, so maybe that's not the best idea. Then what other options do we have? Something that we typically see during recessions is that people tend to flock to so-called safe havens. A safe haven is a type of investment that is expected to retain or increase in value during times of market turbulence. They have low volatility but do see good growth in general. Typical examples of safe havens are gold, treasury bills, or defensive stocks, or even cash or other currencies. So, should I liquidate my portfolio and immediately buy all of that stuff instead? Well, the problem is that the market is forward-looking. If at this point you're not already in safe havens, it's likely that many people will have already liquidated their portfolio and moved to a safe haven. This means that now safe havens are relatively expensive because there is more demand, increasing their price. At the same time, the stocks or assets that you are trying to sell in order to move into a safe haven will be relatively cheap because a lot of people have already sold them off. This is a double-edged sword. This means that on the one side you are selling your entire portfolio for cheap, and then on the other side you are buying it all back expensively. The final nail in the coffin for safe havens is that while they have sometimes done well in past recessive periods, there is absolutely no guarantee that safe havens will outperform any other type of asset. As a result, investing in safe havens is far from a reliable strategy when trying to limit the damage of a recession on your investment portfolio. There is no harm in allocating some of your portfolio towards these assets, but it won't necessarily insulate you from the recession. Option number 3. Moving your investments from one sector to a different sector. Historically, some industries and sectors are considered to be better placed to fare reasonably during recessions, such as utilities, healthcare, and consumer staples. Generally, industries are known to fare better if they supply the population with essentials that we cannot live without. So, should I take some of my stocks from tech and move them into food, for example, in order to try and dampen the impact of the recession? Well, you can try, but industries and sectors that thrive during one recession might struggle during another, and not all companies in the same industry share the exact same characteristics, with some being more cyclical than others. So, if you want to do follow this strategy, it's still important to pay very good attention to what you are investing in, and to keep in mind that there is absolutely no guarantee that you will outperform the market. If we look at the market, we'll see that tech has already taken a pretty deep nosedive in 2022, so is it reasonable to expect it to dive that much deeper in 2023? These are the kinds of things you should keep in mind while making decisions. So, then, if those 3 things are not an option, what can I do in order to insulate myself from a recession? Well, the best strategy, of course, is if you see the recession coming before everyone else does, sell off your riskier investments and pivot towards either safe havens or more defensive assets. If you are, however, too late and are not willing to sell cheap and buy expensive in order to do that, then here I have some tips for you in order to weather the storm. The first thing to do is take a look at yourself and review your investing strategy. Are the investments I'm making still in line with my risk tolerance? For example, if you're still young and you've got a good job that you're unlikely to lose, you might be willing to take more risks when investing than if you are older or do not have set job stability. Next, review your current investment positions. Are they still in line with my overall investing strategy and risk tolerance? Do I need to diversify or perhaps buy some different businesses than what I'm used to? If you're certain that you're still doing the right thing and you have the time to wait out the recession, then actually you're facing a huge opportunity. Currently, everything is going to be cheap, so anything that you buy for a reasonable price is going to trend upwards after the recession ends, and you'll have bought it for cheap, which is going to be even better for your final return when everything returns to normal. Thank you for watching our video. We hope that you have found this information useful and informative. If you did, consider liking this video and/or subscribing. This has been Finance for Fun. See you next time.